Welcome to Griffonomics.
It is, it's really good to be back.
Today is Thursday, February 19th, 2026. And I want to start off this deep dive by just asking you a question. When you think about the bedrock of the global economy, like the actual stuff that keeps civilization running day to day, what comes to mind for you?
Usually, I'd say oil,
Yeah.
semiconductors, obviously, maybe data centers these days, given the AI boom.
Right, exactly. And if I told you we were going to spend the next hour or so talking about a company that makes fertilizer, you would probably tell me to go watch paint dry. Or, I guess more accurately, watch corn grow.
I might definitely check my watch, yeah.
But that is exactly where the mistake lies. We're doing a deep dive today into CF Industries. And the big aha premise I want to just put right on the table right now is this. CF Industries is not a fertilizer company.
I mean, they are.
Well, they are,
Yeah.
sure, but that is the boring way to look at it.
Okay, so what is the exciting way?
They are actually a stealth clean energy powerhouse. They are this legacy company that has somehow figured out how to turn the cheapest energy source in America, which is natural gas, into essentially a battery that can power Japan, fuel ocean freighters, and completely decarbonize the grid.
That is a much sexier title than agricultural chemical analysis. I will give you that.
Right. This isn't a story about growing soybeans anymore. This is a story about the hydrogen-nitrogen arbitrage.
And looking at the massive stack of sources we have in front of us today, the full year 2025 earnings report that just dropped yesterday, the Q4 earnings call transcripts, all the 8K filings and investor presentations, your argument actually really holds up.
It does, and we have a ton to get through for you today. Our mission here is to unpack how a legacy industrial manufacturer is using a massive structural moat to basically fund a transition into the hydrogen economy, and doing it without bankrupting its shareholders.
Which is the trick, isn't it? I mean, everyone wants to go green, but nobody wants to go broke doing it.
Exactly. So here is the roadmap for you as we get into this. We have three big pillars for today's deep dive. First, the gas spread moat. This is the economics of why they are just printing money right now.
The cash engine?
Yep. Second, the operational reality, which includes a pretty nasty hiccup in Yazoo City that we absolutely need to dissect.
Yeah, we can't ignore that part.
No, we can't. And third, the clean energy pivot. Specifically, we'll look at the ExxonMobil partnership and the massive Blue Point joint venture.
It is a heavy stack of material.
Mm-hmm.
But before we get into the billions of dollars and the margins, we really need to set the context for you. It's February 2026. The world is incredibly energy hungry.
Starving, really. And that brings us to section one, the cash engine. Let's talk about the business model and those 2025 financials. But first, for the listener who maybe hasn't touched a chemistry textbook since the 10th grade, what does CF Industries actually do?
Ideally, we keep the chemistry lesson brief here, but you really cannot understand the money if you don't understand the molecule. The core process they use is called Haber-Bosch. It is arguably the most important invention of the entire 20th century.
Because it feeds the world.
Literally feeds the world. Without it, roughly half the global population would not exist today. The natural soil just couldn't support the crop yields we need.
So what is the actual recipe?
Here's how it works. You take natural gas. Natural gas is basically methane, right? CH4. So that is 1 part carbon and 4 parts hydrogen. You strip that hydrogen out of the gas.
Okay, so you've got hydrogen.
Then you grab nitrogen from the air. The air around us is 78% nitrogen, and it is totally free, which is my absolute favorite price for a raw material.
Right, you can't beat free. So you have hydrogen from the natural gas and nitrogen from the thin air.
Exactly. You put them into a massive reactor under immense heat and immense pressure, and you synthesize ammonia, NH3. That is the magic molecule.
So ammonia is the base. Essentially, everything else they sell is just a remix or an upgrade of that basic ammonia.
Correct. And if we look at the 2025 revenue breakdown from yesterday's report, ammonia itself brought in $2.18 billion.
Just the raw stuff.
Yeah, just the raw gas, which is usually compressed into a liquid for transport. It is 82% nitrogen and 18% hydrogen. It's used directly for some farming, but also for industrial applications.
Okay, so that is the foundational product, 2.18 billion. Then you have UAN.
UAN stands for urea ammonium nitrate. That product brought in $2.16 billion last year.
And what exactly is that?
It is a liquid solution. It's roughly 28 to 32% nitrogen.
Why do farmers specifically want a liquid?
Speed and precision. Imagine you are a farmer in Iowa and you have 5,000 acres to cover. You do not want to drive a tractor back and forth spreading dry pellets if you can avoid it.
Because it takes too long.
Way too long. With UAN, because it's liquid, you can put it in a massive sprayer boom. And even better, you can mix it with your herbicides or your pesticides in the exact same tank.
Oh, so you do one pass over the field instead of three.
Exactly.
Yeah.
It is all about logistics. It allows the farmer to cover massive amounts of ground very quickly during what is a very tight spring planting window.
Convenience definitely sells. $2.16 billion worth of it. Then you have granular urea. That was $1.78 billion.
Right. Urea is the solid form. It is 46% nitrogen. That is the absolute highest nitrogen content you can possibly get in a solid fertilizer.
But if liquid is so convenient, why would anyone choose the solid over the liquid?
Because of transport and storage. If you were shipping fertilizer from a plant in Louisiana all the way to Brazil or to India, you really do not want to pay ocean freight rates to ship water.
That makes sense.
Yeah, UAN is heavy because it is mostly water in a solution. Urea is just concentrated dry pellets. It's the absolute standard choice for global trade.
Okay, and then there is this industrial and other bucket in the earnings report.
Which includes diesel exhaust fluid, or DEF.
Right, which if you drive a modern diesel truck, you definitely know about.
You absolutely do. You have to pour that blue liquid into a totally separate tank in your truck to reduce your emissions. That fluid is urea-based. It chemically scrubs the bad stuff, the nitrogen oxides, out of the exhaust before it hits the tailpipe.
And they also make nitric acid in that bucket too, so that is the product mix. And we should note, they operate the world's largest ammonia production network. They are doing this at massive scale.
Unbelievable scale.
So let's look at the scoreboard now. The full year 2025 report. Give me the headline numbers.
The headline is simply cash. Net sales hit $7.08 billion.
Over $7 billion.
Yes, net earnings were $1.46 billion. But the number that really matters, and we need to be specific here for the listeners who follow the financials closely, is adjusted EBITDA, which came in at $2.89 billion.
Okay, let's stop right there. Adjusted EBITDA. I always hate the heavy finance jargon. Can we use a checkbook analogy here? EBITDA is sort of like your gross salary before you pay your mortgage or buy your groceries, right?
That is pretty close. EBITDA is earnings before interest, taxes, depreciation, and amortization.
Right.
So it is a proxy for the raw operating cash flow of the business operations themselves. It totally ignores how the business is financed with debt or how it gets taxed. It just tells you how good the physical machine of the company is at making money.
But you can't actually spend EBITDA.
No, you absolutely cannot. That is why the much more important number is free cash flow, FCF.
And what is that, practically speaking?
Free cash flow is what is actually left over after you have paid for all the factory upgrades, the regular maintenance, the new pipes, the capital expenditures, or CapEx. It is the cold, hard cash that finally lands in the company's bank account that management can do literally whatever they want with.
And what was that free cash flow number for 2025?
$1.79 billion.
Okay, let me do some quick math here. They had $2.89 billion in EBITDA, and they turned that into $1.79 billion of actual cash.
Yes. That is a 62% conversion rate.
Is that considered good?
It is spectacular.
Really?
Oh, yeah. To give you some context on that, the average S&P 500 materials company, so we're talking mining, other chemicals, paper, cap, about there, they usually convert their EBITDA to cash at about 28%.
Wow.
And the broader industrial sector is around 51%. So CF Industries sitting at 62% means they are running an incredibly efficient ship. They aren't spending wildly on bloated projects that don't generate a return.
So they have this massive pile of cash, $1.79 billion sitting there. What exactly are they doing with it? Are they building gold-plated headquarters? Are they buying sports teams?
No. They are doing something that I like to call the cannibal strategy. They're essentially eating themselves.
Buying back their own stock.
Aggressively buying back stock. In 2025 alone, they spent $1.34 billion to buy back shares.
Wow.
They retired 16.6 million shares in 12 months.
Let's just pause on that for a second so you can grasp it. 16.6 million shares. How big is that relative to the whole company?
That is roughly 10% of the entire company. Gone. Retired. Sucked out of the public market in a single year.
That is, frankly, insane. So imagine if you owned a pizza. It has 10 slices, and the chef comes out and just removes one slice, but the remaining 9 slices somehow grow to magically fill the exact same box. Your individual slice just got 10% bigger without you doing a single thing or spending a dime.
That is exactly how buybacks work. You own a larger percentage of the future cash flows of the business. And this isn't just a one-year wonder for them because they had a good 2025. This is basically their religion.
How far back does this go?
If you zoom out to 2010, they have reduced their total share count by 57%.
57%. So if I bought shares back in 2010 and I just sat on my hands and did nothing.
Your ownership stake in the company has more than doubled, simply because they took their cash and bought out everyone else around you.
That is wild.
It's comparable to companies like AutoZone or even Apple in terms of just the relentless mechanical nature of the buyback program.
But why do they do this? Is it because management just has no better ideas for growth?
Well, that is certainly the cynical view you hear sometimes, but the management view and the view of a lot of their investors is that the public market is just wrong about their valuation.
How so?
They look at their free cash flow yield. Between 2021 and 2025, their average free cash flow yield is 13.7%. They are trading at a multiple of roughly 7.6 times their free cash flow.
Which means what to the average investor?
Which means they are incredibly cheap. Think about it this way. If you were buying a private business down the street, say a car wash, and it paid you back 13.7% of your total purchase price in pure cash every single year.
You would buy that in a heartbeat.
Exactly. You'd break down the dare to buy it. The public market prices CF Industries like a cyclical dinosaur that is going to go bust any minute. Management prices them like a massive cash compounder.
Yeah.
So they buy their own stock because they genuinely think it is the absolute best investment they can make with the money.
Okay, so we've established they are a cash machine, and they use that cash to reward shareholders. But now we really need to ask why. Why are they making so much money when so many other industrial and chemical companies are really struggling right now?
And that brings us to section 2, the structural moat.
The gas spread.
This is the most critical part of the entire thesis. If you do not understand the gas spread, you simply do not understand CF Industries.
We said earlier that natural gas is the main ingredient. It's the feedstock for the Haber-Bosch process.
Right. So gas prices dictate everything. They determine your cost floor. If gas is cheap, you make money. If gas is expensive, you burn money fast.
So let's look at the global map. CF operates primarily in North America.
And thanks to the shale revolution, the fracking boom over the last decade, North America has an absolute abundance of natural gas. It is practically overflowing. In 2025, CF's average cost for natural gas was just $3.31 per MM2.
$3.31. I want you to just keep that number in your head. Now let's look across the ocean at Europe.
Europe is a totally different story. They do not have massive domestic gas reserves like the U.S. does. They heavily rely on imports.
Which means liquefied natural gas, or LNG.
Right. LNG from the U.S. or from Qatar, or they rely on pipelines from Norway. And the LNG process is intense. That involves taking the gas, freezing it to a liquid, putting it on a specialized ship, sailing it across the Atlantic Ocean, and then regasifying it on the other side. That is a very expensive logistical chain.
How expensive are we talking? What is the European gas price?
European gas prices have been hovering around $9 to $11 per MM2.
Okay, so do the math on that. CF pays roughly $3. Their European competitor pays $11.
It is nearly a 4x cost disadvantage for the Europeans. And in a pure commodity business like fertilizer, where everyone is selling the exact same molecule, you simply cannot survive a 4x cost disadvantage. You will bleed cash.
So what happens to the European producers? Do they just take the loss?
No, they turn the lights off. They physically curtail production. The recent earnings report really highlighted this. As of December 2025, approximately 20% of Europe's entire ammonia capacity is shut down. Curtailed.
Because literally every single ton they produce loses them money.
Exactly. And it's not just the raw ammonia. 25% of their urea capacity is offline too.
But the world still needs fertilizer, right? People still need to eat. The demand didn't just vanish because European gas got expensive.
That is the beautiful kicker of this whole structural moat. The demand has not gone away. Farmers still need to plant corn. So the global price of nitrogen is ultimately set by what we call the marginal producer.
Which is the high-cost guy in Europe.
Right. The global market price has to be high enough to convince at least some guy in Europe to turn his plant back on to meet the demand, or at least high enough to cover the massive cost of importing it from somewhere else.
So the global price stays very high, set by the $11 gas reality. But CF is producing their product with $3 gas.
And they are pocketing that massive difference. That is the arbitrage. They are selling into a global market that is priced by very high energy costs, Well, they get to enjoy a local market with incredibly low energy costs.
But is this sustainable? I mean, could the U.S. gas price just suddenly spike? Or the European price crash?
It is possible, sure, but it's highly unlikely in the near or even medium term. Building new LNG export terminals in the U.S. takes years and billions of dollars, so there is a bottleneck. The structural disconnect, which is literally the Atlantic Ocean, acts as a massive physical barrier that keeps U.S. gas trapped and cheap at home, and European gas heavily reliant on expensive imports.
It is a literal geographic moat.
They are just standing on the right patch of dirt, geologically speaking.
And it isn't just Europe struggling, right? What about the other big global players?
You have places like Trinidad and Iran. Both of them have massive natural gas reserves. But they have chronic, severe operational issues.
Like what?
Well, Trinidad, for example, has been suffering from structural gas curtailments. They physically cannot get the gas out of the ground fast enough or reliably enough to feed their chemical plants at full capacity.
And what about China? They are a massive player in everything.
China is always the wild card in commodities. They are a massive producer of urea, but they prioritize their own food security above global trade.
Makes sense.
So they have repeatedly restricted urea exports seasonally. They just cut off the exports to keep the domestic fertilizer supply cheap for Chinese farmers.
And when they do that, it takes a huge chunk of supply completely off the global market.
Exactly.
So you have this incredibly tight market, you have constrained supply globally, you have a high global floor price set by Europe, and CF just sits there with the lowest cost structure in the world. It honestly sounds perfect.
Financially, it is a very, very strong position.
However, and there is always a however in these deep dives, it wasn't a totally perfect year operationally for them. We have to talk about Section 3, the operational hiccup.
Yes, the situation at Yazoo City.
This happened back in November 2025. What exactly went down?
So the company hasn't released a full public forensic engineering report, which is standard, but we know a major incident occurred in the ammonium nitrate plant at their Yazoo City, Mississippi complex.
And these are not gentle machines.
Not all. These are incredibly high-pressure, high-temperature environments. When things go wrong in a plant like this, they tend to go wrong mechanically, and they go wrong significantly.
And the earnings report yesterday dropped a pretty big bomb regarding this. That specific facility is entirely offline, and they said it won't be back until Q4 of 2026.
That is a massive outage. We are talking about a full year of complete downtime for that unit.
Is that normal?
Absolutely not. In the chemical manufacturing industry, a standard scheduled turnaround for maintenance is maybe 2 to 3 weeks. A one-year outage implies a catastrophic equipment failure.
Like what kind of equipment?
Likely a primary reactor vessel or a massive compressor train that has an incredibly long lead time to replace. You can't just run down and buy these parts at Home Depot. They have to be custom cast, forged, tested, and shipped.
So what is the actual financial damage from this?
They are estimating a $200 million EBITDA headwind for 2026.
$200 million.
Yes. And it is not just the repair cost of the metal, it is the lost volume. They noted they lost about 600,000 tons of gross ammonia production.
Wait, let me make sure I have this straight. If the ammonium nitrate plant broke, why are they losing raw ammonia production?
That is a great question. It's because chemical complexes are tightly integrated continuous loops. If you can't process the raw ammonia into the final upgraded product, which is the ammonium nitrate, and you don't have enough physical tank storage or pipeline takeaway capacity to move that raw ammonia somewhere else, you are totally stuck.
You just run out of room.
Right. So you have to physically throttle back the front end of the plant. You have to slow down the actual ammonia production because the molecule literally has nowhere to go. It becomes a massive operational bottleneck.
That makes total sense. Now, if I am an investor reading this report, hearing year-long outage and $200 million hit makes me extremely nervous. Why isn't the stock totally crashing on this news?
2 words: business interruption.
Insurance.
Exactly.
Yep.
They carry heavy business interruption insurance for exactly this type of disaster.
How does a policy like that actually work at this scale?
It is a policy that covers the gross profits you would have made if the plant had been running normally. And this is a very big impairment, but for investors, it is not an instant payout.
Right, insurance companies aren't known for their speed.
Never. There is usually a waiting period deductible, often 30 to 60 days, where the company just has to eat the raw loss. After that time passes, the insurance coverage finally kicks in.
But they don't just write a $200 million check the next day, right?
No, you have to meticulously prove the loss. You have to submit massive amounts of production data, market pricing data. Then the adjusters argue about it. Then eventually they pay.
So that impacts the cash flow timing.
Heavily. Management specifically warned on the call that cash flow in 2026 is going to be bumpy.
Bumpy.
Yeah, bumpy. You might have a seemingly terrible Q1 and Q2 on paper, and then suddenly a massive insurance check lands in Q3 that covers everything retroactively.
So the underlying profitability will likely be recovered, but the timing is just really messy.
Correct. Though they did already take a $25 million asset impairment charge in Q4 2025 just to formally write down the completely destroyed equipment off the balance sheet.
Here is my main takeaway on the Yazoo City thing. It really highlights the inherent risk of the old economy business model. You are totally reliant on big, heavy, dangerous machines. If one valve fails or one compressor breaks, you are instantly in trouble.
That is absolutely fair. It is pure operational risk.
Which bridges us perfectly to the next section. Because the future of CF Industries isn't just about running these old, risky fertilizer plants. It is about pivoting to a model where the profit is actually guaranteed by utility contracts, not by farm weather or machine reliability.
Let's get into it.
Section 4.
The clean energy pivot.
This is the massive strategic inflection point we talked about at the top of the show. They are moving from feeding the world to fueling the world.
Let's start with the absolute crown jewel of this new strategy, the Blue Point joint venture.
This is a $3.7 billion project located in Modeste, Louisiana. And we have to be clear, it is not just another fertilizer plant.
What makes it so different? Really, it comes down to two things, the technology they are using and the customers they are selling to. Let's start with the tech side. They are using something called autothermal reforming, or ATR.
Okay, we need to geek out for a second on the engineering. Most standard ammonia plants today use something called SMR, right? Steam methane reforming.
That's right.
Why are they spending billions to switch to ATR?
It is entirely about carbon capture. In a traditional SMR plant, you burn a lot of natural gas just to create the massive heat needed for the reaction.
Right.
That combustion obviously produces carbon dioxide. But that CO2 goes up a giant flue stack mixed with nitrogen and water vapor and everything else. It is a very dilute stream of gas.
Okay, so it's mixed together.
Trying to catch the carbon out of that dirty smoke is like trying to pick only the red M&Ms out of a massive swimming pool filled with blue ones. It is incredibly energy intensive and therefore very expensive.
And ATR fixes that.
Yes. In autothermal reforming, the chemical process itself produces a very pure, highly concentrated stream of CO2 as a direct byproduct. And it comes out under high pressure.
So it's already separated.
Basically, yeah. Catching that CO2 is very easy. To use the analogy, it's like the M&Ms are already perfectly sorted for you before you even start. So if your ultimate goal is to make blue ammonia, which is ammonia where the carbon emissions have been successfully captured, ATR is by far the superior technology.
So they are building this massive, high-tech, low-carbon plant, $3.7 billion. Who is actually paying for all of this?
This is the financial beauty of the deal. CF is not going it alone and taking all the risk. They have partnered with JERA, who is taking a 35% ownership stake, and Mitsui, who's taking a 25% stake. CF retains 40% and acts as the actual operator of the plant.
For the listener who doesn't track Asian utilities, who is JERA?
JERA is Japan's largest power generator. They are literally the utility company that keeps the lights on in Tokyo.
So why on earth does a Japanese electric utility want to own a piece of an ammonia plant in Louisiana?
Because Japan has a severe structural energy crisis. They have virtually no domestic oil. They have no natural gas. They have very limited land for massive solar capacity. And they are understandably very nervous about restarting all their nuclear plants after Fukushima.
They are an island. They have to import energy.
Exactly. And they have made a national strategic decision that ammonia is going to be a key fuel of their future.
A fuel? You can actually burn ammonia to make electricity.
You can. Remember the chemical formula? NH3? It does not contain any carbon. So when you burn it, it does not release any CO2 into the atmosphere. It just releases harmless nitrogen gas and water vapor.
Wow. So what is JERA's actual plan for this?
JERA plans to import this low-carbon ammonia from Louisiana all the way to Japan and co-fire it in their existing coal power plants.
Coal fire.
Essentially, they will mix roughly 20% ammonia with 80% coal and burn them together.
Hold on. I have to play devil's advocate here. Isn't that just massive greenwashing? I mean, you are still burning 80% dirty coal. You are just extending the life of a heavily polluting power plant.
That is a very valid criticism, and trust me, environmentalists in Europe and the US are screaming about it. They argue it absolutely prolongs the coal era artificially.
Right.
However, from Jerry's perspective, reducing their immediate emissions by 20% right now, using existing infrastructure, is far better than waiting 15 years and spending billions to try and permit and build a brand new nuclear plant. It is a pragmatic transition step for them.
And for CF Industries, I imagine they don't really care about the optics of Japanese coal plants. They just care about the locked-in contract.
Exactly.
And is the contract solid?
Extremely solid. It involves a contract for difference directly backed by the Japanese government.
Explain how that works.
Look, blue ammonia natively costs more to manufacture than regular blending ammonia. Let's say, for example, it costs $500 a ton to make the clean stuff, but the global market price for dirty ammonia is only $300.
No utility is going to voluntarily pay that $200 premium if they don't have to.
Exactly. So the Japanese government steps in and essentially says, we will pay you the difference. They directly subsidize that price gap to ensure the project is economically viable for both the producer and the utility.
That is incredible. So CF has a guaranteed utility buyer in JERA. They have a subsidized guaranteed price floor from the Japanese government, and they have their partners paying for roughly 60% of the upfront construction costs.
It is an absolute masterclass in capital de-risking. CF puts in roughly $1.5 billion of their own cash, and they get a permanent, extremely lucrative foothold in the Asian clean energy market.
So what is the timeline on this?
The FID, the final investment decision, is officially done. Construction is starting this year, in 2026. And they expect commercial production to start flowing in 2029.
But 2029 is still 3 years away. What about right now? Because they are doing clean energy stuff today, right? This brings us to the ExxonMobil partnership.
Right. This is happening today. As of January 2026, the Donaldsonville CCS project, that's carbon capture and sequestration, is fully operational.
How does a fertilizer company end up partnering with big oil?
It is a perfect division of labor. CF Industries makes the ammonia at their existing Donaldsonville complex. They use their equipment to dehydrate and compress that CO2 byproduct we talked about earlier.
So they get it ready to move.
Right. Then, right at the literal fence line of their property, they hand it over to ExxonMobil.
And what does Exxon do with it?
Exxon built and owns the pipeline. They take that compressed CO2, transport it to a very secure geologic formation, which is basically a highly porous rock layer, thousands of feet underground, and they inject it.
They just bury it permanently.
Yeah, yes. They are currently capturing and burying 2 million metric tons of CO2 annually.
I have to ask the safety question here because I know people are thinking it. We have all heard the horror stories, like Lake Nyos in Cameroon back in the 80s, where a natural CO2 cloud just erupted from a lake and asphyxiated thousands of people. Is this safe?
Yeah.
Just injecting millions of tons of suffocating gas underground?
Look, it is absolutely a risk that has to be heavily managed. But the geology in Louisiana is exceptionally well suited for this. These are the exact same tight rock formations that naturally held highly pressurized oil and gas for literally millions of years without leaking.
So the logic is, if the rock held explosive gas in for 1 million years, it can hold CO2 in.
Exactly. But obviously, leaks from the wellheads or the pikes are a theoretical possibility. And that is exactly why Exxon is the partner here. They are the undisputed global experts in deep subsurface engineering. If anyone on Earth knows how to put stuff underground and keep it there safely, it's them.
Okay, but why go through all this trouble? Is it just corporate altruism? Are they just trying to be good guys?
Absolutely not. It is entirely driven by the 45Q tax credit. The United States government pays a direct tax credit, which scales up to $85 per ton for permanently sequestered carbon.
Okay, let's do the math on that. 2 million tons a year times $85.
That is $170 million in sheer economic value created annually out of thin air. Now, CF and Exxon split that money somehow. The exact contractual terms aren't fully public, but they have essentially taken a totally useless waste product that used to just vent into the sky and turned it into a massive recurring revenue stream.
And they aren't stopping at Donaldsonville. They just signed a deal for Yazoo City too, right?
Yes. Starting in 2028, once that broken plant is fully fixed and upgraded, they will begin capturing another 500,000 tons a year over at Yazoo.
So the U.S. government is paying them to bury the carbon. But here's my question. Does the actual end customer pay more for this low-carbon ammonia, or is the tax credit the only benefit?
That was the big unknown for a long time. But on the earnings call yesterday, management finally confirmed it. Yes, they are actively selling low-carbon ammonia at a distinct premium to European buyers right now.
Why would a European buyer voluntarily pay extra for the exact same molecule?
It is because of CBAM. The carbon border adjustment mechanism.
What is that?
It is essentially a European climate tax on imports.
Hmm.
If you are a European company and you import dirty, high-carbon fertilizer from overseas, you get hit with a massive tax at the border. But if you import certified, clean, low-carbon fertilizer, you don't pay the tax.
Oh.
The tax savings are so huge that the European buyer is more than willing to pay CF Industries a premium for the green stuff because they still come out way ahead financially compared to paying the border tax.
It's just regulation driving raw economics.
Perfectly stated. It's a totally manufactured market, but the cash is very real.
Okay, there is one last piece of the clean energy puzzle we need to hit. The POET partnership. This is a fascinating one because it connects the farm directly to the fuel tank.
Right. POET is the world's absolute largest biofuel producer. They make ethanol.
Walk us through the cycle of this partnership. How does it actually work?
It's a chain. CF Industries makes this low-carbon fertilizer we just talked about. They sell it to a U.S. corn farmer.
Okay.
The farmer uses it on their fields. Now, because the fertilizer itself had a drastically lower carbon footprint, the resulting corn that grows from it can be officially certified as low-carbon corn.
I didn't even know that was a thing.
It is now. So the farmer takes that certified corn and sells it to POET. POET then takes the corn and ferments it into liquid ethanol. Because the original input, the corn, was low carbon, the final resulting ethanol fuel has a much lower overall carbon intensity score, or CI score.
And why does a low CI score matter to POET?
45Z.
Another government tax credit.
Yep. The Clean Fuel Production Credit. The way the law is written, the lower your CI score is, the higher the actual tax credit you get per gallon of fuel produced. And we're talking about value that can be worth cents or even dollars per gallon.
That adds up incredibly fast.
By linking the green fertilizer directly to the green fuel, CF and POET are together unlocking that government money across the entire agricultural value chain.
So CF is really no longer just selling bulk nitrogen. They are selling, what, carbon intensity reduction?
Exactly. They're fundamentally an energy transition company now.
This is just a massive amount of information to take in. The transformation is huge. Let's zoom out for Section 5. Outlook and verdict. Where do things stand right now?
Let's look at the guidance for 2026.
Management says the current market is tight.
Very tight. They expect severe supply constraints globally to last at least through the first half of 2026.
What does that mean for prices?
Global urea prices are sitting around $450 per ton right now, which is a very, very healthy margin for them. Like we said, they are printing money at these cost levels.
But they are spending a lot of money, too. CapEx is projected at $1.3 billion this year.
Right, but $600 million of that is going straight into the Blue Point joint venture. That isn't just maintenance. That is pure growth capital for the future.
So here is the real debate. I am going to play the bear here, the skeptic.
Go for it.
I look at all this and I say, look, it is still a commodity agricultural business at its core. If global corn prices crash, and they do crash, farmers will simply stop buying premium fertilizer. All this clean energy stuff you're talking about is still mostly years away from being the main profit driver. This is a classic cyclical value trap. Why shouldn't I just sell the stock right now while things look good?
That is the textbook cyclical argument. And honestly, it's valid. If corn goes to $3 a bushel, CF stock will absolutely go down. That is exactly why I rate the cyclical short-term side of this stock as a hold date. You have to be very careful with agricultural cycles.
Okay, fair enough. Now give me the bull case. Why am I holding on for the long haul?
The compounder thesis. I rated a strong BUY on the long-term fundamentals.
Because of the moat.
First, the gas spread, yes. Even if corn crashes hard, CS-based production costs are so incredibly low compared to the Europeans that they will always be the last one standing. They have an unbreakable floor under their earnings.
And the second reason?
The clean energy premiums. The income they are getting from the 45Q tax credits with Exxon and those future utility contracts with JRA, those are not cyclical.
Right. JRA needs power regardless of the price of corn.
Exactly. Those contracts are fixed. They are totally uncorrelated to agriculture. They are going to start smoothing out the wild earnings volatility that usually plagues fertilizer companies.
Management put out a pretty big number for the future, didn't they?
They are officially targeting $3 billion in mid-cycle EBITDA by the year 2030.
$3 billion as a baseline.
Right. And a huge chunk of that $3 billion will be highly predictable, non-cyclical, contracted utility cash flow. A business model like that simply deserves a much higher valuation multiple than a standard boom-and-bust fertilizer company.
So you are basically buying the transition. You are buying the fact that they are taking today's cyclical fertilizer profits and using them to build tomorrow's totally stable utility contracts.
Precisely. It's a brilliant capital allocation strategy.
We have covered a lot of ground today. The Haber-Bosch chemistry, the aggressive stock buybacks, the disaster at Yazoo, the Japanese utility partnership.
It's a complex story, but a good one.
I want to leave you with one final kind of provocative thought before we go. We talked briefly about ammonia potentially being used as a clean shipping fuel.
Right, for the big ocean freighters.
Exactly. If companies like Maersk and the other big shipping lines actually switch their massive engines to run on ammonia to meet climate goals, and CF Industries, with its massive scale, becomes their main global fuel supplier.
Then they literally aren't a chemical company anymore.
Right. At that point, does CF Industries stop being a competitor to agricultural companies like Mosaic and Nutrien and actually start being a direct competitor to Shell and Exxon?
If that transition actually happens, the market valuation of this company completely changes. Energy majors trade at totally different multiples than chemical companies. They have different capital structures. It would force a total fundamental re-rating of the stock on Wall Street. It is the ultimate oil major upside case.
Definitely something for you to mull over as you watch this space. As the CF management team likes to say over and over in their slide decks, risk defined, portfolio protected.
I couldn't have summarized it better myself.
Thanks for joining us for this deep dive into Griffonomics. We will see you next time.